Hello, I'm Kirk Eck, a shareholder here at Cook Martin Polson. Today I want to discuss employer reimbursement plans and the different effects they have on the employer and the employee. There are two types of reimbursement plans that an employer can provide: an accountable plan and a non-accountable plan. An accountable plan is the preferred plan because all of the reimbursements qualify as deductible expenses for the company, but are not classified as income to the employee. A non-accountable plan, however, results in a deduction for the business, but the reimbursement is classified as taxable income to the employee. All reimbursements from a non-accountable plan are reported on the employee's W-2 and are also subject to all normal payroll taxes. To qualify as an accountable reimbursement plan, the reimbursement must meet three requirements. First, the expense must have a business connection. This means that the expense must be job-related and be normal and ordinary with respect to the business. Second, the expenses must be substantiated. The employee must provide documentation to the company sufficient to show that the expense is attributable to the employer's business activities. Third, the reimbursement may not exceed the actual amount of expenses substantiated. An employee must return to the company within a reasonable period of time, usually not longer than 3 months, any amount paid under the arrangements in excess of the expenses substantiated. This means that if a company has a per diem travel allowance of $50 per day and the employee only spends $25 per day, the employee would have to return the excess $25 per day that they did not spend. If the employee does not return the excess within a reasonable period of time, that amount should be included on their W-2 and is subject to all payroll taxes. As long as you can prove that you do these three things, you can rest assured that the IRS won't expect you to classify your reimbursements as wages. One last thing to note: if your mileage reimbursement rate is greater than the IRS's standard mileage rate, which is currently 56.5 cents per mile, the additional amount above this standard would need to be included on the employee's W-2. For example, XYZ company reimburses their employees at 76.5 cents per mile for the mileage they drive in their personal vehicles on behalf of the company. Because XYZ pays 20 cents per mile more than the IRS's standard rate, they should classify the extra 20 cents per mile as payroll expenses, and the additional amount should be included on the employee's W-2. If you have any questions about your company's reimbursement plan or any other tax-related issues, please contact us. We'd love to help you out.